I'm Tom White, joined again by Kevin Hincks, and also Scott Bauer's back, the CEO of Prosper Trading Academy. All right, guys, markets kind of stabilized here.
He's still up 10.
We did see. We didn't mention oil earlier, and I know that oil was down a little bit this morning, and we hit off a 20-session low or highs yesterday, but you know, crude market's still up there because there's some headline risk still out there based on Venezuela.
Inventories tonight, too.
Yeah, inventories, API tonight.
We all know what those numbers really mean.
Not much lately, right? Yeah, exactly. All right, guys, let's get into a discussion about Spotify first. We just talked to Landon Swan from LikeFolio.com. Saw a lot of commentary and data from him based on what they're seeing as far as happiness and purchase intent mentions. It's actually pretty solid for this particular name, Scott. Option market's pricing in a plus or minus move of about $11, so pretty significant on a $138 stock here. What do you look at in names like this going into it if you want to, if you have an assumption you want to play this using options?
So in this case, with an assumption to the upside here, I'd look at one of two things. I'd either look for perhaps an upside call calendar, take advantage if there's some implied volatility to take advantage between this week's options and maybe next week's, or an unbalanced put butterfly, kind of like what you had set up over there, which actually looks pretty rich right now. I saw the one that you were setting up.
Only $2 wide strikes.
$2 wide strikes. Nice. What I would maybe look for, though, just to see how much premium, is get the strikes down a little bit. Maybe look at the 128, 126, 124 to see if there's a similar type of premium. But that 170 or 180 that we had in there before, that's pretty juicy.
Yeah, and just moving those strikes down, you're still collecting about $1.20, $1.25 credit on that particular trade. So that's a good point, because if we do have an outsized move in there, you get a little bit more protection to the downside. One key item of note that we kind of wanted to point out here, Kevin, was typically we look at the option stats page. Now, why isn't there anything up here in IV percentile over here on the left, Kevin? And that's because this is a brand new IPO'd company.
Right. They have no real history.
No 52-week based data on that. And if you take a look at the chart, you can kind of see that we don't have enough data for those metrics to come up on the site. So it's not an error. It's just that there's not enough data to compile that stuff. So that's a good point. But let's move back to that trade that Scott has up there, Kevin. Do you like the outlay of this, or do you like going closer where that $11 move was in the sweet spot?
Yeah, it depends on if you have a strong opinion on this stock.
Right.
Because the 130, 128 with the short being the 128, that was right on the expected move.
It was.
Correct.
This one, Scott's given himself a little room. Still, a fair amount of credit, more than enough to justify doing the trade. So you get to $1.25 credit, you're fine there, and you've got even a higher probability on this one.
Yeah, and let's take a look at the Analyze tab on that particular trade and the risk profile. And you can see we actually might have something old in there, Kevin, if you want to get rid of that. But yeah, there's the 128, 26, 24. You got that break-even point just below 125 on this particular trade. So it does give you that probability of finishing out of the money, a little bit better probabilities of success. And Kevin's got, he's going to reset the slices on that. It's positive time decay. It's a short Vega trade.
But long delta. Make no mistake.
Long delta.
You're selling multiple amount of short put verticals, so you're going to have a long delta on this, even though you have a chance on the downside for a little kicker with the long put vertical.
Right, so you can have that bullish sentiment towards it, be wrong, but still do really
Great visual that pitch made.
Still do really nice.
Butterfly, which really shows that key area there.
Yep, and you got to remember that middle strike in a long unbalanced put fly on something like this, that middle strike is your apex, where you're going to make the most profit. You have the most profitability in a particular trade. But make no mistake, this is a neutral to bullish type stance. But you win in 3 out of 4 scenarios in this, guys. If it goes up, stays where it is, or goes lower, but remains above that break-even point.
Let's do that one.
Well on that. And that's
that one's in and working. Let's keep working.
Really short base trade. Now, Kevin, take a look at the in that same series. If somebody wants to do just a simple, instead of doing the put butterfly, because you got a lot of risk in that, do a simple short put vertical around that same level. So here's the 26.24. You're only gaining about 35-cent credit.
Yeah,
That's $1.65 in risk.
Remember,
and
why?
$2 wide.
Because you've gone past the expected move, so you're a little bit lower. One of you did right at the expected move, which is 128,
right.
126.
Probably going to be closer to 75, 80 cents would be my guess.
Now there's a
45,
still not a great number.
That's surprising. Like now, Scott, that brings up a great teaching point. Scott said, "Oh, it's going to probably be 75, 80 cents." And we went up $2 on that closer to where the current share price is. It's only only about a dime higher.
Right. So, it's really an evaluation of reward to risk on every type of setup. And, it really behooves users on a Thinkorswim platform to play around with the strikes a little bit and see what criteria meets their criteria best for that reward.
And when that might tell you some of the put skew might be pretty heightened.
Right.
That's why even though we went further out, we got a nice number on our butterfly, but not the short vertical. It must be the pretty heightened skew numbers.
Yeah, and if you want to just use probabilities, because that's usually one of the guidelines that we look at, here you got a probability of finishing out of the money about 71% at the 129 strike. Now, that being said, it's within or just at, the break-even point is going to be just at that anticipated move that the option market's pricing. But I think it all goes back to your assumption on this, right? You can create a strategy based on where you think this thing's going to go post-earnings.
The genesis of every trade should be your opinion, right? Bullish, bearish, or neutral.
Yep, because you can always find a strategy to take advantage of that. So Kevin's got that in. Let's move over to GM real quick because they have earnings in the morning. And this stock got a big boost on the 11th of January from CEO
you can see it right there.
Mary Barra.
Yep, look at that.
That big jump on Investor Day where they raised their fiscal year EPS guidance from 650 to 650 to 7 from a consensus of about 590.
What the American car makers are doing to streamline their inventory and their margins is somewhat impressive. Yeah. I mean, they're going to be lean companies when all this is done. GM and Ford, they're going to build, it's SUVs and trucks. One or two cars, and then it's SUVs and trucks across the board.
Yeah, and you see on the trading platform here, GM's got earnings, guys. The current IV percentile rank down at 33%, and so it's relatively low going into an earnings report. And you know what? These car companies, I don't know if they're investable. They pay, GM pays a dividend, right? It's highly traded.
Almost 4%?
Yeah, almost 4% dividend. People like to be involved in these automakers, Scott. Do you look at this as a tradable product or an investable type product?
More investable.
Yeah.
Frankly, I quite honestly, I have never traded a single contract in my professional career, either on the floor or off the floor in GM. It's just something that I look at that and there's no volatility to it and it doesn't excite me, so I move on. That being said, it is 100% completely tradable because there's a lot of volume, a lot of open interest, a lot of activity in there.
Yeah, and just based on that low volatility environment, I just created something real quick. Buying the 39.5, 37.5, $2 wide put vertical. Buying it instead of selling it kind of goes against our positive time decay theme, but at the same time, it's relatively inexpensive. You only need to move a lower of about 25 cents post earnings for that to pay off.
Right, because you know what? You're already 40 plus cents in the money on that.
Correct.
So that's why the overall dollar cost, 76 cents seems expensive, but from a premium standpoint, there's only 30 some odd cents of premium in there.
Yeah, if this stock stays above 39 where it currently is, this thing's going to melt relatively quickly, and that's one of the detriments about buying verticals as opposed to selling them. But that's going to wrap up our show, guys. Great conversations about strategies. Thanks to Scott Bauer, CEO of Prosper Trading Academy, for joining us today. That does it for Fast Market. Tune in tomorrow, 10 a.m. Central Time, right here on the TD Ameritrade Network. Have a great day, everybody.